Think about this for a second. Last year, everyone was expecting this. In the news, in bank emails, in conversations with your colleagues. Interest rates are going to come down soon. You were already planning for it. As soon as rates come down, I will refinance. As soon as rates come down, I might be able to borrow a bit more. And then 2026 arrived, and something completely opposite happened. Rates did not come down. Rates went up 3 times. Your mortgage statement arrived, and the number had gone up. You probably thought, how is this even possible? Everyone said cuts were coming. Today, I am going to tell you exactly what happened, why it happened, and most importantly, what you should do about it now. By the end of this video, you will know exactly what happened to interest rates in 2026. You will know why it happened, explained in completely simple language. You will know the real impact on your mortgage. And most importantly, you will know what to do about it right now. So let us go from the beginning. How interest rates actually work. A lot of people think this is simply a decision banks make on their own, but in reality, it is an entire system. The RBA, the Reserve Bank of Australia, meets every 2 months, and it decides on a number called the cash rate. This number directly affects the entire Australian economy. When the cash rate rises, it becomes more expensive for banks to borrow money, and banks pass that extra cost on to your mortgage. When the cash rate falls, the opposite happens. It is one entire chain, starting at the RBA and ending up at your monthly repayment. Now let us understand exactly what happened with the timeline. At the end of 2025, the RBA made a few rate cuts. The cash rate dropped to roughly 3.6%. Every Australian was happy. Mortgage repayments were getting a little lighter. Many people thought, this is the trend now. Rates will keep coming down. But as soon as 2026 began, things started to shift. The first rate hike happened. People were a little surprised but thought, this is probably a one-off. Then the second hike happened. Now confusion began. Then the third hike happened. 3 times in 2026, the RBA raised the cash rate. Today, in June 2026, the cash rate sits at 4.35%. This is the highest level since late 2024. For people who were expecting rates to fall, this was a genuine shock. And honestly, it was not just an ordinary Australian shock. Many economists did not see this coming either. Now let us understand why this actually happened. There is one simple reason: inflation. Inflation means how fast prices are rising. The RBA's target is to keep inflation between 2 and 3%. But this target has been exceeded since mid-2025, and inflation is not coming down as quickly as the RBA expected. People are still spending, despite higher prices. That means demand remains strong, and when demand stays strong, prices keep rising further. There is another factor as well. There have been disruptions in global oil supply, which has pushed energy prices higher. And when energy is more expensive, transport, manufacturing, and groceries all become more expensive too. This creates a chain reaction. The RBA only has one tool to control this situation: raising interest rates. When rates rise, people spend less. Borrowing becomes more expensive. Spending slows down. And in theory, inflation comes down. This is simple cause and effect. But it means that until inflation is under control, the RBA will need to keep rates high or potentially raise them further. Now let us look at the real impact on your mortgage. Let us look at real numbers. If you have a $600,000 mortgage, for every 0.25% rate increase, your monthly repayment goes up by roughly $92. If you have an $800,000 mortgage, combining all 3 rate hikes in 2026, your monthly repayment has gone up by roughly $485. $485 every single month. That becomes $5,820 extra every year. Just from interest rate changes, nothing else changed. Your home is the same. Your salary is probably the same. But every month, $485 less is left over. For many families, this number is creating genuine pressure on the budget. School fees, groceries, petrol, everything has already gotten more expensive this year. And on top of that, this extra mortgage cost has arrived too. But here is an important point to understand. Banks do not pass on every RBA decision exactly. Some banks move first, some move later. Some raise rates more, some raise less. So if your bank has not raised rates yet, that does not mean they will not. And if you have a variable rate loan, these changes affect you directly. If you have a fixed rate loan, you will not feel any impact right now. But when your fixed period ends, you will need to refinance at the current higher rates. This is a silent trap that many people miss. They think, my rate is fixed, I am safe. But if your fixed period is ending next year, you will feel the impact of this increase very soon too. Now let me tell you about a silver lining in all of this. High interest rates are not only bad news for borrowers. For savers, this is actually good news. When the cash rate rises, savings account and term deposit rates rise too. That means if you have savings, you can now earn more interest than before. Some banks are offering more than 5% interest on high-interest savings accounts. This is an important reminder. Every economic change is not a one-sided story. What creates pressure for borrowers can create opportunity for savers. If your emergency fund is sitting in an ordinary account, now is a good time to check whether a better rate is available. Now let us talk about the future. Will rates go up further, or will they finally come down? Honestly, no one can guarantee that. The RBA's next meeting is in August. Economists say that if inflation data improves, rates could stay stable. But if inflation persists, another increase in August is possible. This all depends on incoming economic data. The important thing to understand is that this is not following one fixed path. The RBA makes its decision based on data every single meeting. So the best approach is to keep flexibility in your planning. Hope for the best case, but prepare for the worst case. So for today, 5 simple steps. First, check your current interest rate and see whether you have a variable or fixed loan. Second, contact your bank and ask whether a better rate is available. Many people are able to negotiate. Third, review your household budget and account for the extra repayment amount. Fourth, if you have savings, check whether your current savings account interest rate is competitive or whether you could earn more elsewhere. Fifth, if your fixed rate is ending within the next 12 months, start planning now so you are not caught by surprise. I want to be honest with you. I have seen this myself. The expectation that rates would come down soon sent a lot of Australians planning in the wrong direction. This was not your fault. Even economists could not predict this accurately.
But now that you know exactly what is happening, you are better prepared. Review your mortgage, adjust your budget, and remember, this is not a permanent situation. It is part of a cycle. Interest rates do not stay high forever, and they do not stay low forever either. They move like waves over decades. It might feel high today, but it is not permanent. If this video gave you clarity, do one thing for me. Hit the like button. It helps this real information reach more Australians. Subscribe and turn on notifications. In the next video, we are going to talk about exactly how to manage your mortgage repayments if rates rise further. I will see you there.